Hey, welcome back to the Unlearned Investor. I'm glad you're here. Quick disclaimer before we get into it, I'm not a financial advisor. Nothing I say today is financial advice. This is purely educational. Always do your own research and talk to a certified financial professional before making any investment decisions. So, last time we talked about inflation, how central banks quietly shrink the value of your cash over time, like a slow leak in a boat. You don't notice it until you are already ankle deep in water. And at the end of that episode, I left you with one question. If cash is slowly melting, where do you actually put your money? That's what today is about. But here's where I want to start. Not with a list of investments, not with numbers, but with a question that most people get completely wrong. What actually is an asset? Ask your neighbor. He'll point at his SUV, his new TV, maybe his watch. And honestly, I don't blame him because nobody ever sat us down and explained this properly. So, let me give you the simplest definition you'll ever hear. An asset puts money in your pocket, a liability takes money out. That's it. That's the whole game. Think about a rental property. Every month, someone pays you rent, it feeds you. Now, think about a car. The second you drive it off the lot, it loses value. Then it needs fuel, insurance, service, repairs. It eats you. Same person, same garage. One is feeding them, one is eating them. So the next question is obvious. What actually qualifies as an asset for a regular person trying to build wealth? Let me walk you through 7 categories, 7 buckets. Each one works differently, each one has a catch, and understanding all 7 is how you stop guessing and start building. The first bucket is cash in a bank. Safe, easy to access, government insured in most countries. But here's the catch, it slowly loses value to inflation every single year. Cash in a bank is not a growth vehicle. Think of it as your ready ammunition, kept there so that when a real opportunity shows up, you can move fast. The second bucket is real estate. This is the classic one. Tangible, generates rent, tends to rise with inflation over time. The catch is it's illiquid, meaning you can't sell a bathroom when you urgently need cash. High entry cost, hidden expenses, property tax, maintenance, those months where the tenant just doesn't pay. It rewards patience and research. The third bucket is gold, 5,000 years of track record. No company behind it that can make bad decisions. No bankruptcy risk. Gold is what people call an inflation hedge. When the value of money falls, gold tends to hold its ground. The catch? It pays you nothing. No rent, no dividend, no interest. It just sits there and you only make money when the price goes up. The fourth bucket, and this is the big one for most regular investors, is stocks. Owning a small piece of a real company. The best long term wealth builder on this list. Some stocks even pay dividends. That's regular cash paid to you just for owning the stock, like collecting rent without owning a building. The catch is volatility. Prices go up, prices go down, sometimes dramatically. Stocks reward patience and punish panic. The fifth bucket is bonds. Think of a bond as you lending money to a government or a large company and they pay you interest in return. Predictable income, lower risk than stocks. The catch, lower long term returns, and inflation can quietly eat into that fixed income over time. The sixth bucket is intellectual property, a book, an online course, a piece of software, a podcast, even. You build it once and it can earn for years. No starting capital required, only your skill and your time. The catch? Most intellectual property earns nothing. Building something people will actually pay for is genuinely hard. But when it works, it really works. And the seventh bucket is owning a business. The highest reward potential on this entire list. Full control, scalable, but also the highest failure rate, the most time consumed, the most capital at risk, and honestly, the most stress. This one demands everything from you at once. 7 buckets, 7 different tools. The skill is not collecting all 7. The skill is knowing which tools fit your life right now. Now, here's the question I know is already forming in your head. What about my job? I get paid every month. Does that make my job an asset? It's a fair question. And the honest answer is no. You don't own your job owns you. It can be taken away by a layoff, a bad quarter, a health problem, or just by getting a little older in an industry that wants someone younger and cheaper. You are not the owner of that arrangement. You are the product being rented. The company is renting your time, and they can end the lease whenever they want. Your job is the engine that buys assets, but the engine itself is not the asset. And that is the entire point of investing. To one day build a portfolio so strong that the engine becomes optional. Now, let's talk about where people really get tripped up: the liability in disguise. Your car is not an asset, your phone is not an asset, your designer watch is not an asset, and your credit card, that's the opposite of an asset. It's a tool that lets liabilities multiply faster than your salary ever can. I call this the lifestyle trap. Every time your income goes up, the spending goes up to match it. Bigger car, newer phone, better holiday, and somehow, no matter how much more you're making, the bank balance never really moves. The money's coming in, it's just leaving through a slightly fancier door. The trap isn't the things themselves, the trap is mistaking them for wealth. But here's something I want to be honest about, because most finance content won't say this. Not all liabilities are bad. There's a real difference between what I'd call a destructive liability and a strategic liability. A destructive one drains you and gives you nothing back. Credit card debt at 20% interest. A car loan on a vehicle that just sits in the driveway. A personal loan you took for a holiday you've already forgotten. Money out, nothing growing on the other side. A strategic liability is different. It's debt you take on deliberately to acquire something that earns more than the debt costs. A mortgage on a rental property where the rent covers the repayment and leaves something over. A business loan for equipment that generates more profit than the interest charges. That's not debt dragging you down. That's debt being used as a lever. Think of a lever. Even a heavy one helps you lift something bigger than you could alone. But a lever used carelessly crushes you. So before you ever take on debt, ask yourself three questions. Will this fund an asset? Will that asset earn more than the debt costs? And if the income from that asset disappeared tomorrow, would I survive? If the answers are yes, yes, and yes, it might be worth considering. If the honest answer anywhere in there is just I want it, walk away. That's a destructive liability dressed up in good intentions. And then there's the gray zone, things that are a bit of both. Your home is the perfect example. It costs you money every single month: mortgage interest, property tax, maintenance, insurance, but it also shelters you. It tends to rise with inflation over the years, and someday you'll own it outright. Is it an asset? Is it a liability? Honestly, it's both. And that's okay to admit. The point isn't to memorize categories. The point is to train yourself to ask one question every single time money leaves your wallet. Is this going to feed me or eat me? Alright, let's bring this home. The goal for someone like you and me, an average person saving for retirement, not a trader, not a fund manager, is actually very simple to say and genuinely hard to do. Buy assets, reduce liabilities, build a portfolio that takes care of you when you can no longer take care of yourself. And trust me on this, the day comes sooner than you think. Three rules I want you to carry with you. Rule 1: never lose your capital. Capital is the seed. You can grow more from a small seed. You can grow nothing from nothing. Protecting what you have always comes before chasing what you don't. Rule 2: you only have to beat inflation. You are not racing Wall Street. You are not competing with your neighbor or the guy at dinner bragging about his crypto gains. The only benchmark that actually matters for your retirement is the rising cost of bread. Rule 3: diversify by purpose, not just by name. Some of your portfolio should pay you regular income: bonds, dividend stocks, rental property. Some should grow quietly in the background: growth stocks, gold, maybe a business. You need both working together. And here's the simplest retirement calculation I know. Write down your monthly expenses today, multiply by inflation over however many years you have left. That number, that's roughly what your investments need to cover when your paycheck stops. Any portfolio that reaches that number without risking your capital is, by definition, a great investment for you, not for the market, not for anyone else, for you. Okay, that's a wrap on episode 3 of The Unlearned Investor. In episode 4, we are going to talk about how regular people actually buy these assets, the actual products and accounts available to you, and how to start building step by step. If you found this useful, subscribe to the Substack at unlearnedinvestor.substack.com. The podcast syncs automatically so you'll never miss an episode. Until then, see you and take care. Signing off, the Unlearned Investor.